Let's talk about real estate syndications. This could either be for somebody who's looking to be a syndicator or somebody who's looking to join another syndication. What are some of the reasons why somebody might be looking into a syndication? One reason is to, from the syndicator's perspective, is to increase the capital that they have at their access available for investing in different projects. They might have their capital tied up already, might be their first project, might be a larger project, and they would otherwise be able to invest it and to engage in. Another reason might be skill sets. So you might take on investors that have a particular skill set to complement the skill sets you have or otherwise. For example, myself as a tax CPA, I was brought on both as an investor as well as doing the preparing the tax returns for the partnership. Who are the different parties and what do they do? Really briefly, you have the sponsor and you have the investors. There could be multiple of each of these, by the way. Multiple sponsors, multiple investors. The sponsor finds the deals, has the investor connections. You can see what it has over here. The sponsor can also be an investor. The investor, they're going to generally contribute capital. Sometimes they might contribute other services. They could also be the signer on a loan. So it's kind of fluid. The roles could between the sponsor and investor. They there is some overlap over here, but there are also very specific uh, jobs, tasks, requirements, essentially, of what the sponsor is, what makes somebody a sponsor. For example, finding the deals and having the investors. The Generally the sponsor is going to make their fees in the following way. This is a high level summary of it. You have the acquisition fee, preferred return, also known as the pref, waterfall, management fee, disposition fee, financing fee. Those are a few, and we're going to talk about each of these, at least the top ones, in a little bit more detail. The acquisition fee. Acquisition fee essentially, and a lot of these are negotiable. You'll see that they're essentially negotiable. If there are multiple sponsors, they can be split. So you can the sponsors, two different sponsors, for example, can split the acquisition fee from any one investor in any ratio that they decide. If, for example, one sponsor brings in an investor that they know, they would likely get a larger share of the of that investor's of what they've paid in the acquisition fee. It's also known as the finder's fee, and it essentially a 10%. So typically, a 10% of capital contributed, if they contribute, whatever they contribute, whatever percentage of the capital that's contributed by each investor, they they will be paying that portion of the acquisition fee. It'll make a little bit more sense later. If not, don't worry about it. This is just a high level. So we're going to see an example, and all of this might make a little bit more sense. And if there are, and the sponsors, if there are multiple sponsors or even one sponsor, they're obviously not going to be charging themselves an acquisition fee. The preferred return, that is essentially going to be a almost a guaranteed rate that is going to be based on the percentage that an investor invested in a project. So if it's 10%, if they invested $200,000 and their preferred return is 10%, they're going to get $20,000 right off the bat once the property sells or meets its whatever it's if it's flipped over, if it's converted into another property. So essentially, once the cash is received, then that is when the preferred return will be received by the investors. The waterfall is going to be the most interesting one. It could be any agreed upon rate. 50/50, 10/90. This is gonna make a lot of sense once I show you the example. All of these will make a lot of sense. So then there are other potential fees, and then we have an example. We have the management fee, disposition fee, financing fee. So for example, if a loan is either secured or obtained, whoever is signing off on it might receive a fee for that. Okay. Take three. Sponsor A contributes capital of $100,000. Investor B contributes capital of $200,000. The preferred return for investor B is 5%, which is going to be $10,000. The waterfall calculation is you take their capital contribution of $200,000 divided by the purchase price of $700,000, which gives you 29%. Essentially, they contributed 29% of the purchase of this property. Then you take what the potential gain is of $300,000 and multiply it by that percentage. So their potential gain, the preliminary gain, would be $88,000. But wait, they already received $10,000 over here. So we have to remove that $10,000, and that gives you $78,000. Then there is the waterfall agreed upon 50/50, which you take that $78,000 and then they will essentially receive $38,000. Tack that $38,000 onto the $200,000 on top of the $200,000 they originally contributed, and they're going to receive back $248,000, which is the waterfall amount of 38K, the preferred amount of 10K, and the principal balance of 200K. So that's where the 248 comes from over here. Then you have the 528 from investor C. Now, because we're not going to be able to go back to the slide for some reason that I don't know right now, but just keep in mind that the sponsor is going to walk away with 224K, which includes their $100,000, which is the sale price, the amount paid to investor B, the amount that will be paid to investor C, and they're going to keep the balance. This could also be calculated in a similar way, but the easiest way is just to remove the amounts that were paid to the investors since we already calculated that. So now we're going to move on to the next slide and look at investor C and we're going to see how investor C came up with 528K as their new capital balance. So for this slide right here, we have investor C contributes capital of 400K, and we can just see the $528,000 right there that we're going to get to. The preferred return of 7%, which is $400,000 of $400,000, which is $28,000, and their waterfall is 70/30. So they're going to get a preferred return of $28,000. Now, how do we calculate the waterfall? Is they contributed capital of $400,000 over a total purchase price of $700,000, which gives them a 57% capital contribution percentage. Their preliminary gain is going to be calculated by the 57%, multiplying the 57% by the $300,000 gain, which would give them $171,000. But wait, they already got paid $28,000. Remove that, and then you run the waterfall. So the 143K times the 70%, which is their portion, it just happens to be what they negotiated, their portion of the waterfall, which gives $100,000. These numbers are rounded. $100,000. Now their new capital balance is going to be this 100,000 plus this 28,000 plus the 400,000, which equals $528,000. And the balance goes to the sponsor. They put in $100,000. They came out with $248,000, whatever that number was. Not a bad investment, and they took on a lot of responsibility. So, and as well for this investor, if you think about him, he put in 400K out of a $700,000 deal and walked away with $528,000. So he put in the bulk of the investment. but did walk away with a nice profit. Looks about 25% ish, more than 25%, right? So that's pretty nice. This is my contact information if you want to reach out. If you have any questions, we offer a complimentary 15-minute consultation if you would like. Again, my name is Michael Wander. Well, not again, because I think this is my first time introducing myself on this call. Michael Wander, feel free to reach out if you would like. Hope this was helpful. I would love to hear from you if you have any comments or if you find that this helped you.